I look at a 6-month bill, it's at 16 basis points. Today, 3- and 5-year note yields most likely will be making new all-time low yield closes at 18 and 30 basis points respectively right now. How does one invest in short-term securities and make some money?
Exactly. You know, Rick, we're faced with low rates for the foreseeable future. In fact, you know, there's two things that we need to be focused on. One, that zero interest rates are really a secular phenomenon. We're seeing low rates, as you see, contributing to this really flat yield curve. But at the same time, when you look at it, we're also seeing a higher savings rate than usual. Today's economic data confirms that, and we see a solid savings rate effectively come out at north of 20%. And although it's probably going to come down in the foreseeable future, it's still going to remain relatively elevated as folks become more defensive. So ultimately, more cash on the sidelines, as you've highlighted, money market funds that are all-time records. And ultimately, we have to be faced with how to make something of these low rates. And taking steps out of this short-term space means that investors have to look to invest their savings beyond the money markets, beyond T-bills, beyond the 2-year note, and look to a diversified portfolio of high-quality assets. And in doing so, there's actually some pretty great opportunities out there despite this secular trend of very low rates.
Now, why don't you give us a quick idea of how we can diversify, of course, maybe out of equities, and I'm not saying equities aren't going to be forging ahead, but to be more balanced, what's on the other side of this portfolio to keep me in the game and not force me into locking low money market rates?
Exactly. And I think that's where diversification comes in. The high savings rates mean people are more defensive. And ultimately, when you look at the portfolio construct, it does mean that people want a little bit less volatility. Admittedly, the Federal Reserve has done a great job about taking some of that volatility out of the marketplace through all their liquidity facilities. Investors should ride on top of the back of the Federal Reserve and look to the front-end segments of the markets to diversify portfolios of high-quality structured products, high-quality corporates that are really effectively being sponsored by these liquidity facilities for the Fed. And in doing so, they can find yields of 1% to 2% for relatively short interest rate exposure and taking very minimal credit and structured products exposure. Now, one of the things we have to realize is that the environment is moving on to one where liquidity was the focus, and unfortunately, solvency risk is going to be a focus. So remaining defensive, high in quality, and taking small steps to short-term strategies is actually the right way to go that gives investors optionality for the future to invest their capital and really to sit a little bit on the sidelines while managing liquidity to earn those rates of 1% to 2%.
You know, Jerome, you mentioned the Fed, and I think this is a topic we can get into. I only have about a minute and a half, but, yesterday, every Thursday, we learn what the Fed's balance sheet has done, and it decreased just a smidge, hovering at $7.1 trillion, which, by God, that's so large when you think about it, but it is smaller than it was the previous week. But the point is that they said only about $100 billion of the $2.6 trillion of firepower has been used. I think it's around 4%. Can you weigh in on that and the notion that, you like corporates, obviously the Federal Reserve is going to sponsor and underpin corporates, and boy, do they have a lot of firepower left.
Yeah, I think a diversified portfolio, and really the Fed has done a good job of sponsoring that diversification through their TALF facility, through the secondary market credit facility, and this is focused on liquidity. What I still think we need to be focused on is protecting capital and understand that this market process is going to move from one of liquidity, which the Fed has clearly been focused on in allocating that 4% of capital that you highlighted, to really one of solvency and concern about earnings. So even though the Fed's involved, we still have to be defensive for our portfolios for clients. And investors, whether they're in equities or fixed income, need to take that more defensive posture while we continue to evaluate the economic scenarios to come. But the Fed, as you mentioned, though, has really only anteed a small amount, which means, A, their commitment is still out there, and B, it's left unused.